Hi, I'm Brian Kessens, Senior Portfolio Manager with Tortoise Capital, here to talk about what happened in energy markets in the month of May. We thought we might change it up a little bit this month, with a little bit of a different format, and I just canvassed what questions we're getting from clients, what we're talking about internally, about what might have happened in May, what was moving the markets, maybe what wasn't. So we'll just start with some questions. First question. We reached a ceasefire with Iran in May, seemingly we did, bringing oil prices lower. What did that mean for broad energy performance? Certainly we did reach some sort of a ceasefire, although daily it seems like there's still some skirmishes going on, and that did lead oil prices quite a bit lower actually during the month of May. We started May, or if you go all the way back, I guess, to the end of April, WTI crude oil prices was at $105 per barrel. This is June 1st, last Friday, the end of May, we were $87 per barrel. Our oil prices declined about 19%. So pretty material decline over the course of the month of May, and no surprise, a lot of times crude oil is the overall sentiment driver for energy stock prices, and energy as measured by all the energy companies in the S&P 500 fell about 5.5%. Midstream energy seemingly followed the course, down a little bit less, but still down. Midstream ended down about 4%. And I think this month in particular, it was all top-down driven, all driven by what was going on in the oil markets was really weighing on all energy stock prices. If we expand it a little bit and look at what happened with utilities, interesting, were down as well. They were down about 5%. What's going on with utilities? Really not seemingly historically correlated with oil. What they are correlated with at times are interest rates, and across the board we saw U.S. Treasuries, whether it was the 2-year, the 5-year, the 10, or even the 30-year. Generally, Treasury rates moved higher, and I think that probably weighed on utilities a bit. But despite what was going on in the energy value chain, hey, the S&P 500 was making new highs. Again, S&P 500 was up about 5%. I think what supported the overall market was GDP, despite the fact that oil is a bit of a tax on the economy, but GDP growth for the second quarter looks like it's going to come in, at least consensus is at about 3%. Productivity remains pretty good. The jobless rate remains relatively low. Everything looks pretty good. Profit margins are higher across the board for S&P 500 companies, so we saw the S&P perform pretty well. Natural gas, really not a lot to see there. Natural gas prices kind of ebbed and flowed around $3 per MMBTU. That said, if we do look at what's going on from a year-to-date perspective, energy has had a great year so far. We're up 26% versus the S&P, which is up 11%. Although for the month of May, that did narrow just a little bit. Next question. So first quarter earnings largely wrapped up in May. What did we learn? And we actually learned quite a bit, I think. We always had this question a bit in the back of our minds, hey, if oil prices actually do move higher, especially maybe the forward curve in a bigger way, what would the energy producers do? What would midstream companies do in that environment? Would they actually increase production? Because the past 5 years they've been really disciplined, and you know what? So far they continue to be really focused on that capital discipline. We saw a couple of exceptions with producers where they said that they're actually going to increase production between now and year end to take advantage of the higher prices, but that really wasn't rewarded in the stock market. And a lot of the upstream companies continued to tout, we're focused on returns and returning capital to shareholders, not necessarily by trying to grow production. In the midstream landscape, what we learned is, hey, the LNG exporters are the place to be. Especially if you are an LNG exporter that has actually some uncontracted volumes, and you're able to take advantage of the fact that international LNG prices have moved higher, especially relative to Henry Hub prices that we have domestically. Take advantage of that, lock in some of those spreads for 2026 and 2027, and be able to generate some outsized returns. The LNG exporters were able to actually take up their guidance by taking advantage of that. And the rest of midstream companies were generally in line too. We did have some beats. Beats were largely with some marketing opportunities, taking advantage of some price differentials between different basins and so forth. But all in all, the midstream sector performed pretty well too. If we do look at going further downstream to the refiners, hey, downstream had a really incredible first quarter. performance. They're able to take advantage of the fact that refining margins, not only in the U.S., but especially globally, if you can export refined product, gasoline, diesel, and jet fuel, you're in really great shape to take advantage of those high margins. They're benefiting from that. U.S. Refiners in particular as well are benefiting from the fact that one of their inputs, that being natural gas prices, remain relatively low, especially relative to the rest of the world. And if you thought 1Q was good for the refiners, the second quarter should be even better, because if really in the first quarter they were really only able to take advantage of the situation in the month of March, and the second quarter seemingly they're going to have about 3 months of these elevated refining margins to take advantage of. Utilities, similar story from what we saw last year. CapEx continues to move higher. We need more and more generation, transmission, and distribution. Utilities not only took up their CapEx, but they're taking up their earnings per share as well. Nearly every utility across the U.S. is growing their earnings somewhere between 6 and 9%, and a couple are actually being able to exceed 9%. We did do a word cloud, which I thought was interesting from earnings. No surprise on the words that popped up more so than others. Energy security, reliability, physical delivery capability, infrastructure constraints, LNG exports, and domestic supply resilience all came up. Or if you think about one thing to capture that, it would be HALO. This heavy asset, low obsolescence theme really dominated what we saw within earnings over the course of May. Next question. What do you make of the Iran war and oil prices today? Probably the broadest question that we continue to get, and I think there's just 3 words to kind of describe what's going on. Still no deal. Seemed like over the course of the entire month, as we went into every weekend, a deal or a memorandum of understanding between the two nations, that being U.S. and Iran, was forthcoming, yet it doesn't seem to have happened. We had that over the past weekend as well, and here we are again with no deal. Despite that, we did see, as we talked about, oil prices move lower for the month. I think, frankly, there's a lot of actually good stabilizers that are helping out the oil price. One, the West has a lot of reserves, strategic petroleum reserves, that we're making use of. We're taking about 1 million barrels per day out of our reserve, and we're actually exporting it. U.S. exports, which for the past couple of years have averaged about 4 million barrels per day of crude oil. For a couple of weeks more recently, we've actually exceeded 6 million barrels per day. That's been helpful. China is limiting actually their crude oil imports in a pretty major way. We think they're taking advantage of some reserves that they've built up, frankly, over the past several years. And then another one that doesn't get talked about quite as much, but that's Saudi Arabia. They're taking advantage of this east-west pipeline where they're essentially shipping their crude oil across their country from the east, which is on the Persian Gulf, to the west, which is on the Red Sea, to be able to export more crude oil. We think that production, or that amount that can be transported, is about 7 million barrels per day, so pretty meaningful from Saudi Arabia. So all of those have been some good buffers, at least over this near-term period, to keep crude oil prices at a relative reasonable level. That said, we don't think that we're anywhere close to a deal, frankly. Best case, maybe by the end of the summer, we'll have something more meaningful. Seems like someone's actually going to have to take some real pain in order to bring the two sides together to make a deal. Even today, we have Israel threatening to invade Lebanon, Iran saying that there's pencils down as it relates to negotiations, and our president saying he doesn't care about the situation. Stay tuned, but Iran is still no deal with us. Next question. NextEra Energy announced an agreement to acquire Dominion Energy in an all-stock transaction valued at about $67 billion, creating the world's largest regulated electric utility by market capitalization. Why did they do this, and why should we care? All right, this is a big deal. NextEra is doing it, though, because of artificial intelligence, and the data center demand for electricity continues to grow. Right now, NextEra, at least as it relates to the Florida market, they have the largest regulated utility in Florida. They are considered best in class from a management team about what they do. They keep prices low, and they continue to be able to facilitate the growth in energy, especially as it relates to energy in Florida. Yet they want to take advantage of that expertise and be able to grow in other areas. They looked no further than Dominion. Dominion in particular, where are their service territories? It's primarily in Virginia, it's in North Carolina, it's in South Carolina, and those 3 states we're seeing really robust activity for data centers and power demand. That's also in that PJM region that we've talked about. It's in the middle Atlantic. NextEra recognizes that, and they want to help grow that region. The biggest risk to this deal, we think, is probably regulatory risk. Dominion, that their service territories it's going to require a lot of regulatory approvals. But we think, and NextEra Energy's management team, frankly, has had some success historically with the regulators. In other cases, they haven't had quite as much success. But we think in this deal, recognizing their best-in-class management team in order to keep prices relatively low in that region, we think that the deal will be approved, but probably won't be until sometime in 2027. Last question, just to wrap up here. Hey, summer is starting. What are we looking for as the summer gets underway? As it relates to oil, oil continues to be hostage, if you will, to the geopolitical situation and what's going on between the U.S. And Iran. We're looking for any developments on that as it relates, particularly to the Strait opening. As it relates to energy, frankly, that's the key item that we care about. And the other one, that big secular trend where we're focused on, LNG, natural gas, electricity demand, and overall energy infrastructure needs to grow to facilitate all this power demand. That's really what we're laser focused on as well. So that wraps it up. That's what happened in May. It continued to be an eventful month, and I think that it also will lead to a pretty eventful summer is what we have in store. Thank you.